How do active traders make money? Futures. Futures are derivative financial contracts with expiration. Timing is an important factor of futures that makes it distinct from long-term investments like equity. As a day trader, you can buy a futures contract on stocks, indices, and commodities like gold, crude oil, natural gas, etc. Usually, you hold a futures contract for 1, 2, or to the maximum 3 months according to the contract. During this period, you can choose to sell the position on profit or loss. But on expiry date, it will auto-close irrespective of it being profit or loss. Generally, Nifty, Sensex and Bank Nifty are indices measuring Indian stock market growth, which you can trade in futures contract. For example, if you think market will be up for next 30 days, then buy the Nifty 50 futures contract and earn profit. How futures contract move up and down? Futures is a derivative. That is, whenever Nifty 50 index value has a change, the same is derived and reflected in Nifty 50 futures contract. So, if index value moves up, the futures contract also moves up and vice versa. As said earlier, in futures, trading is done with a broker and it's not between the real parties like in case of equity. Futures is a highly leveraged investment. So, to trade here, you don't have to put in all the money required. Instead, you can start trading by depositing a margin amount to the broker. Also, here we buy shares in lots. A lot is the minimum number of shares that we need to buy or sell in order to trade in futures, and it differs for different futures contract. Let's see an example. Consider the stocks of Infosys Limited. Here, one share of Infi costs 1,165 rupees and 20 paise, and one Infi lot consists of 600 shares. We know in futures we buy in lots. So to buy one lot of Infi futures contract, you need 6,99,120 rupees. Now, imagine the price of one share increased by 1 rupee. It means the price of one lot increased by 600 rupees. So, even a small change brings huge profits in futures, which makes it more preferable for traders. Stocks, commodities, and indices are not finite in futures. So, traders are free to buy or sell whenever they want without limitations. As the liquidity is higher in futures, traders prefer futures over equity to gain more in a short span of time. Let's see more about futures in the next video. Thank you.